So with that, guys, let's move on to the next and final report that Apple presents on its financial statements. And this is the most interesting statement for me. And if you really want to understand the nitty gritties of a business and really understand what is going on, then this is the statement that you should look at. Because this statement tells you what is the money that Apple is actually making, right? This report, called the cash flow statement, reconciles your income statement with your real bank balance. So, what this report actually shows us is what are the different activities that Apple has done during the course of this year that has moved cash in and out of its bank accounts. And the goal of this report is to add up all of those activities that have moved cash in and out of Apple's bank accounts to give us one net number, which you will see right here, called increase decrease in cash equivalence. So this is the goal of the cash flow statement. It shows us all the money that's moved in and out of Apple's bank accounts. Now, the way that this report is broken down is that it's broken down into three sections called cash generated by operating activities, cash generated or used in investing activities, and finally cash used in financing activities. So what we'll be doing in this section is just going over these three sections and talking about the constituents of these three items. So, what's cash flow from operations? The first thing that I would say is that it is a concept which is very similar to net income or profit. And actually, when you will see how the cash flow from operations is calculated, you'll see that it actually starts from net income. And this net income comes from where? The income statement. So really your cash flow from operations, the first step that you start off with is your net income. Now, there are a bunch of different items that we need to add and adjust to allow us to arrive at the cash flow from operations. So you'll see here that net income was 22 billion and cash flow from operations was 30 billion. So there's about 8 billion out of items and expenditure that we'll just be discussing over here. So what are these items that have driven this difference? I'll focus on the main item here and the item which typically drives this difference between net income and cash flow from operations, and that item is the one right here called depreciation and amortization. Now, what exactly is depreciation and amortization? Depreciation and amortization, or which is typically shortened as D&A in accounting terminology, is an expense which is typically included in the income statement. It'll typically be included in the cost of sales, and it's added to the total expenses, and it reduces the revenue on the income statement in order to calculate the net income. However, D&A is not a real or cash expense. Now, what do I mean by this? So, say Apple has a huge factory which cost $10 billion to make. And say the factory has a life of 20 years, meaning after 20 years, the factory will be worth nothing. So, what the accounting standard says is if you divide 10 billion by 20, you get 500 million, And this is the amount by which your property depreciates each and every year. Now, the accounting standard allows companies to deduct this depreciated amount from their revenue and include it as an expense on the income statement. However, when it comes to the cash flow statement, we are concerned by the items which actually move cash in and out of Apple's bank accounts. So, because depreciation and amortization is not a real cash expense, we need to firstly add this back into the net income. And this is effectively what Apple has done right here. So we had net income right here. We add back the depreciation and amortization of 2.8 billion. Next off, we have all these different line items, which I won't go into too much details um, because it'll become an unduly long discussion, and that's not my goal here. My goal here is to give you a good high level understanding and explanation of how these three statements work. But as a point of reference, all of these expenses are, which you see here, are expenses which are lumped together and called working capital. This is the amount that a company needs to run its day-to-day operations. In the case of Apple for 2019, if we simply sum up these amounts, we see that it's roughly around $5 billion. Or this is the amount that Apple has generated from its day-to-day operations. So now that we've discussed depreciation and amortization, let's have a look at all of these other items. Now, I'm not going to go into too much detail and discuss all of these items because this would require having a very detailed discussion, and my goal is to keep this high level and to give you guys a good sense of the three financial statements. So what I will say is that similar to depreciation and amortization, all of these expenses which you see here are other income or expenditure items which are non-cash in nature, meaning they did not actually lead to cash moving in and out of Apple's business, which is why these are being adjusted out of your net income. Now let's talk about this section here. This section is typically called the working capital section. And again, without going into too much detail, it gives us a sense of the money which has been generated as a part of Apple's day-to-day operations. So if we sort of simply sum up some of these items, we'll see that it's roughly around 5 billion odd of working capital, which has been an inflow of cash for Apple in this year. Now, let's move on to the next section, which is investing activities. So the main thing to focus on here is an item called payments for acquisition of property, plant, and equipment, commonly called PP&E. Now, this is one of those items which you're going to see in pretty much every company's financial statement and every company's cash flow statement, and it tends to be one of the most important parts of investing activities. Now, what is this? This is the expenditure that Apple has made on a new factory or a new research and development plan, or the expenditure that it's made on the wear and tear of its existing plants to keep the condition of the buildings up to scratch. So in this year, Apple has spent around 2.1 billion on both building and maintaining its PP&E. The other item which you see here, which is a pretty big item, is 37.4 billion, which is purchase of marketable securities. Now, if you'll recall from our previous discussion on the balance sheet, Apple generates so much cash each year, and it has so much cash just sitting on its bank accounts. And what would be the best use for Apple of this cash? Does it make sense to just leave it on their bank account, or does it make sense to invest it in some money market or financial market instrument? And so in Apple's case, this is exactly what their business team is doing. It's buying, or it's putting Apple's cash in a bunch of marketable securities or financial market instruments for 2019, and this amount was around 37.4 billion this year. So I think you can slowly see how the different items on each of these financial statements actually links back to each other. If you look at some of the other items that Apple has included on its investing activities, we'll see another one being proceeds from sales of marketable securities, which is a concept which is somewhat similar to the purchase of marketable securities, but in effect, proceeds is the exact opposite, meaning Apple liquidated or sold their holdings of some financial assets to get 7.2 billion into their bank account. Now, payments made in connection with business acquisitions is pretty much like it says. This is the amount that Apple has paid to buy up new businesses. And with that, guys, we've basically covered all the key items in the investing activities. Let's move on to the financing activities. So this is all the money that has moved in and out of Apple's bank accounts because of the financing and funding activities that Apple has done. Now, the question is, what are these activities? These are activities where Apple has raised funding through either the stock markets or the debt markets to run their business. So let me give you an example of this. Proceeds from issuance of common stock, which is a non-existent number in the case of Apple, but effectively what this shows us is the amount of funding which a company has raised from the stock markets. Now, if we talk about proceeds from the issuance of term debt, for instance, this shows us the amount that Apple has raised from the debt markets or from different bonds that have given or from different banks that have lent money to Apple. The other interesting things that we have here, which are very chunky numbers, are repurchases of common stock and payments for the dividend and dividend equivalents. Now, what are these? This is the money that Apple pays to investors to the stock market investors who helped Apple raise money several years ago. And dividends and stock repurchases are a sort of return which Apple is making for those equity investors who believed in Apple's story and who actually gave the money to Apple to become the company that it is today. For companies such as Apple who actually generate a lot of cash, this tends to be a big number. And as we can imagine, Apple has spent nearly $24 billion this year on all of these expenses. Now, when we sum up all of these activities, the cash flow generated by operating activities, the cash generated or used in investing activities, and the cash used in financing activities, it gives us a net number called increase decrease in cash. Now, what does all of this mean? So with that, guys, we've covered all the key items on a company's cash flow statement. Now, again, I want to spend some time talking about the interpretation of all of these items that we've discussed on the cash flow statement, and how would I interpret all of the items that we've just discussed. So let's talk about the three key items here: cash generated by operating activities, investing activities, and financing activities. So what this tells us is that Apple has generated a huge amount of cash from its day-to-day operations, roughly 30 billion, $30.5 billion, a huge amount of money. But if you look at the amount of money or the net amount, but if you look at the net change in cash for Apple for 2019, it was minus 8.5 billion. So what does that mean? What that means is that Apple effectively spent $38 billion on its investing activities and its financing activities. Now, why is that? Why is a company like Apple spending, well, 13 billion on its investing activities, which is understandable because, it's spending this money to invest in the capital markets, to spend on acquisitions and buying out new businesses. This makes sense. But what is going on here? Why is Apple paying $25 billion to the equity investors in the form of dividends and repurchasing common stock? Now, this is a very interesting phenomenon, and it is somewhat common for companies of a massive size and scale, such as Apple's. And this is the reality of the world of the financial markets that we operate in, that the equity markets or the people who have provided funding for Apple when it was a smaller company, they want to be rewarded for having this success story that Apple has in order to keep on continuing to support Apple. In order to do that, they require a return from Apple, which the company provides to these investors in the form of dividends and stock repurchases. These are effectively a cash outflow for Apple, which goes into the pocket of the equity investors. So all in all, what this tells us is that despite making $30 billion this year, Apple actually had a net cash outflow of $8.5 billion. Now, again, this is not for a normal company, this would be a massive amount. But for a company like Apple, this is not a big issue because if you remember, Apple has around 40 billion of cash just sitting on its bank balance. So even if the cash reduces by 8 odd billion, it does not really materially impact the company's day-to-day operations. But I hope this gives you a sense of how to interpret the cash flow statement and to really understand what is going on around in the company's business.